Management buyouts involve existing management of businesses partnering with financial sponsors to buy out controlling stake or a complete buyout of the company. Such structures have been historically used in the context of take-private deals, but have also been recently employed for private companies. One of the key commercial challenges in such transactions is the mismatch on valuation. Valuation is a key driver for the seller. Sometimes it is likely for sellers to get better value externally, whereas due to information asymmetry, the management may be more realistic and may not offer aggressive pricing based on forward-looking valuation methodologies. Usually, funding the acquisition by the management is one of the core commercial issues which also has a bearing on the deal structure. A company with steady cash flows and operational revenues may be able to have more flexibility for financial modeling of the business to service debt. In the Indian context, if funds are raised by debt based on traditional leverage buyout structure, there may be constraint on the security package that can be offered to the lenders. The Companies Act restriction on financial assistance also poses a challenge. There are also situations in which financial sponsors may provide equity capital for enabling the buyout with a clear path to exit. If the funding plan involves a combination of debt and equity, the priority of distributions and inter se rights or any subordination among the financial sponsors require detailed discussions. A deal structure involving a two-tier structure with creation of an investment vehicle with participation of the financial sponsors has challenges under Indian law, as such entities get categorized as non-banking financial companies in India, creating complex regulatory challenges. Offshore structures as well have challenges for resident founder entities. So, suitable investment structures have to be thought through to enable funding. The investment structure is also driven by the level at which the debt funding is envisaged. A key aspect in PE-backed MBOs is balancing the interest of the sponsoring investor for value protection and the operational flexibility required by the management for delivering the business plan. Sponsoring investor may seek expansive covenants from the management shareholders on compliance, financial covenants, strict financial controls, robust information rights, non-compete and no conflict obligations, ultimate penalty including shareholding clawback for non-performance of business plan or default situations, but provide greater flexibility on day-to-day matters. VC-driven companies with already established two-tier structures may find it easier to get past structuring constraints. Such companies led by serial investors with proven track record and available liquidity to part finance the acquisition are likely to be a good market for such deal making in which ultimate value unlocking potential exists. Several of such cap tables have financial sponsors looking to exit due to fund life constraints and have already achieved their target returns. Such cap tables pose a realistic opportunity for individuals.